Good morning and welcome to Your Retirement Playbook. I'm your host, Joe Clark. It is so happy to have you along. Hey, we are dealing with a multitude of subjects in this program. And I get a lot of questions that say, Joe, why don't you talk more about the market or what's going on there? So let me just get that out of the way real quickly. I know there's a lot of market volatility and things that are going on, and I've got a lot of opinions, as do most people, about in terms of the economy and what's going on. We are registered investment advisors. We get paid to manage more than $600 million. That is the truth for more than 1,100 families. However, our passion is helping people with the financial journey, and that's dealing with more than just the day-to-day investment decisions that come along. So I don't spend a lot of time talking about economics or things of that are opinion-driven or could change by the time you hear this show. You'll hear me talk about those, or my team talk about those weekly on a video we put out called The Market Carver. It's a free video you can get by going to yourlifeafterwork.com, simply subscribing to it. You'll get that, our newspaper column, and access to this radio show podcast. But we also take this show, and when I occasionally talk about the investment world, we put it on one of our YouTube stations. So Your Retirement Playbook is the full book, and the full show, you can get it just like somebody who's listening on WIBC or WILO or Shine 99 or WHBU, one of our other stations that we're on the radio. You can get our podcast that way, Your Retirement Playbook. You can also find individual segments at the Tax Planning Show, Your Life After Work, the Legacy Planning Show, the Investment Playbook, the Better Giver Show, and the Life Planning Show. You can find those on YouTube if you merely go to them. That way you can kind of break down what kind of information you're looking for to be able to do your research or due diligence if you're trying to act as your own fiduciary. Again, I will remind you, if you're trying to do that, I hope you find our show useful and beneficial. God bless. If not, if you're looking for a fiduciary, that is our business. And we'd be honored to be able to sit down with you and go through a next steps meeting to give you things to consider today, things you're going to want to consider in the future. And if we choose to partner together, what FEG will do for you, and we'll even put that into writing for you. But right now I want to talk about the simplicity of investment decisions, or the appearance of simplicity. And I'm going to go with two primary issues. One is what I call silo thinking, and the second is what I call an orphaned account. So what is silo thinking? Silo thinking is when you have a decision that you have to make, that you make in the confinement or the space of that box. So let's say you have a 401k and your spouse has a 401k. By law, Section 404C of the Department of Labor, I believe is the code, requires you to have a certain number or types of investment options within the 401k. But I think we would all agree not all stock accounts are equal, not all bond accounts are equal, not all fees and expenses are equal. So you may have made the decision in your 401k to save 10%, and your spouse to make the decision to save 10% because you likely had a communication between the two of you and said, we're going to agree to save 10%. And that's all fine and dandy. But let's just think about the ramifications of that particular instance of silo decision making. What if your plan has a dollar-for-dollar match up to a certain percentage, and your spouse's plan does not? Now, in some cases, you may be saving 15% because you make more money. This happens a lot. And your spouse, because their check is smaller, saves nothing, even though they have a match. So even though it's a silo decision, the first thing you want to do is look at both of the 401k plans. That by definition is a silo, by the way. We're only looking at one tax ramification. You really want to look at the whole big picture, right? But within the confines of that silo, of the 401k space, you've got your plan and they've got their plan, your spouse's plan. You need to agree on the amount of money that you're saving from the collective income. That's the way you replace standard of living. Is 10% enough? Maybe. Is 5% enough? Possibly. Is 25% enough? Not enough. Probably, depending where you are on the income level. Should it be equally split based on a percentage based on the income that you each make? Rarely. And I say that because rarely are the matching opportunities the same, right? So if one plan provides a 6% match, or match up to 6%, and another provides a match up to 3%, but it's dollar for dollar and the other one's only 50%, make sure you're getting all of the free money that you can. So, husband and wife, here's our agreement. Here's the amount of money that we're going to save each week. We're going to divide that between these two percentages based on the investment opportunities inside of those accounts, because the investment options may not be equal. We're going to do it based on the fees and expenses. We're going to do it based on the matching of what our employer is going to provide or kick in, and we're going to do it based on the plan document and what rules are allowed. Not all plan documents allow for loans, for instance. Not all plan documents allow for distribution at 55, for instance. There's things that you really need to know and to understand. Not all plans allow for a Roth contribution into the plan and only have the tax-deferred side. So what I want you to understand is the 401k is a silo decision in itself, even though there's two parts. And what we see happen time after time is people look at them as individual plans, and now we've got the silo decision of a 401k cut into half into two silos. You got to bring that operation together. But then you really have to step back and go, okay, here is my big broad-based financial plan. How much money do I need to be able to save to maintain the standard of living? And you're going to go through three phases of finance. You're going to go through an accumulation phase where your number one job, from the financial planning side, your number one job in accumulation is to save the right percentage of your income. The younger you are, the lower that percentage needs to be, by the way. It's the beauty of compound interest. Secondly, you're building tax diversification. So hell or high water, you want to figure out how to get some of your money that is tax deferred. That's the money that your employer is going to put in. So first and foremost, if you have access to a 401k where there's a company match, you're putting money into that to get the company match. If they have a Roth option, you may be wanting to use part of or all of that toward the Roth contribution. It would depend on your tax scenario at the time, right? But you're trying to build that tax diversification. So you want some money that is tax deferred, some money that is tax free, and some money that is after tax. If you had to pick only one of the three buckets, tax free is better than the other two. I would still take money that's taxable every year over tax deferred, but that's because we know how to run investments that create the fewer amount of tax liability on an annualized basis. The impact inside of the IRAs and being long-term partners with the IRS is not my favorite thing. In a perfect world, when you retire, 1/3, 1/3, 1/3. But we're in accumulation. So your two goals are saving the right percentage of your income and building tax diversification. Stage two is preservation. That's where you're still putting money in monthly, but what you've put in there doesn't matter as much as what you've already built up or maintained. And this is where we move into the second discussion. Not just silos, but what I call orphaned accounts. We have people who will come in and have 3 and 4 401k plans from this school system they taught in, this hospital they worked at, this employer they had here, and it may only have $10 or $15 or $20,000, and you've got $1 million overall. And ladies and gentlemen, please don't hold this against me, but when $10,000 doesn't matter to you, I could be the wrong person. I mean, my team could be I still pick up pennies and nickels and quarters on the ground. I can't help myself. It's my job. I want you to live freely, enjoy your financial journey. We try to teach people how to spend, how to decumulate, if you will. But I'm going to squeeze every nickel that I possibly can. And to orphan an account just because you worked there 20 years ago, not to pay attention to the allocation, not to pay attention to how it works with your other 401ks and your other providers, simply is not acceptable in our mindset. We take the time, we do the heavy lifting. You saved and accumulated the money, but we'll get that coordinated inside of your existing plan or an IRA, but we want to bring it into the house. But in preservation, your number one job is to create an investment discipline if you're doing it on your own, one that you can stick to regardless of the nightly news, regardless of reactiveness to things that are going on, one that has a written out required response or a discipline, if you will. If you don't want to do that, you need to hire a fiduciary. That's somebody who is legally obligated to take care of your money as if it were theirs and they were in a similar situation. The Financial Enhancement Group, for instance, we don't sell products. We get paid to manage money. We are legal fiduciaries. That is our job. Then moving into the distribution phase, you have two objectives inside of this one. The first one is the average tax rate of each dollar that is taken out of the account. What do you have to pay the IRS? And then secondly is the volatility between points. So you go in that secondary discussion, the volatility, where you have to learn and stick to understanding that building and during accumulation and preservation, right, is about the growth of an asset base, and distribution is about the income to maintain your standard of living. They're two entirely different concepts, two entirely different levels of risk and volatility that you need to be aware of. But the other part is, what's the average tax rate that I'm going to pay on the money that I can build out? Well, ladies and gentlemen, you've got to go back to accumulation. If you didn't build tax diversification from the beginning, if in those siloed decisions that you were making, if you weren't thinking about what the end result was going to be, then why in the world were you saving the money along the way in the future? Why go out and play 3/4 of a football game as hard as you can play, get bruised up, knocked around, get frustrated, because that's what happens when we're saving and accumulating, right? We're telling our kids no to Disney and going to Gatlinburg instead. We're not buying the car we want. We're buying a newer model or an older model. We're buying a smaller house than the one we want. We're making a lot of decisions in order to have a better future, and yet we continue to ignore the best future that we can have, which is dependent upon that tax rate. You've got to understand building tax diversification as soon as you possibly can, and do it as focused as you possibly can. YourLifeAfterWork.com. There are two tax codes in the United States. Most people believe that's one for the rich, one for the poor. Reality, it's one for the informed and one for the uninformed. Now, tax preparation is what we do every April 15th, where we tell the IRS our story and we endure the consequence. Tax planning is getting to tell the story by putting our assets, our investments, our decisions in the appropriate boxes along the way before the end of the year. Tax planning is what the Financial Enhancement Group does with each of your CPAs, with each of the families that we deal with prior to the end of the year. Starting October 1st, it's game on. It's all about tax planning, not just tax preparation. If you want to work with certified financial planners, CFA, chartered market technician, enrolled agents, CPAs, if you want us to collaborate with your CPAs, call us now at 800-928-4001 or go to yourlifeafterwork.com. Get your tax planning in alignment with your investment planning. Again, that's 800-928-4001 or yourlifeafterwork.com. Well, good morning and welcome back to Your Retirement Playbook. I'm your host, Joe Clark. So happy to have you along. Hey, many of you know, most of you know, that I've been part of the Ed Slott Elite IRA group since its foundation. Hard to imagine that at 16, 17 years old now. I was on the board for 10 years. We meet twice a year for 3 days, so 6 days of my life professionally. We read private letter rulings, go over tax code. That's our focus. I'm there with 400 of my closest friends, including Aaron Rayum, our Director of Financial Planning, but it's CPAs, tax attorneys, and other geeks like myself that understand the importance of tax planning. One of the things that I understand when it comes to tax is that simplifying your life is the best thing that I can possibly do. I don't want to be bothered. You don't want to be bothered, likely, and there's things that we can do to eliminate that bothering. In all of the years I've been in the industry, one of the things that I've heard that bother people the most is having to make quarterly payments, right? So when you become retired, before then, you had a W-2 where your employer withheld money out of your check. Unless you were self-employed, then you've been making quarterly payments all the way along. But your employer withheld money out of your check. They sent it directly to the federal government and usually the state as well. And you didn't have to make any quarterly payments. And then all of a sudden you would get to the end of the year and you would either owe the IRS or they would owe you. Most of the time they would owe you money back, right? So you gave the IRS, congratulations, an interest-free loan. That's a whole nother story. We won't even get into that. When you go to retire and there's no money being withheld from your check, especially going to the state, now all of a sudden you have to make those infamous, tiresome, and many times problematic quarterly payments to the Internal Revenue Service. They're confusing. They're complex. You've got to pay based on when the income was recognized. So if you did a Roth conversion during the middle of the year, your quarterly tax payment for that quarter should go up, or you're going to assess pesky little penalties and interest charges. Maybe you had a sale of a capital gain of a rental property or farm ground, or even inside of your portfolio. Many different things can happen. But if you happen to have an IRA, things can get a whole lot simpler. See, there are two tax codes in the United States. You've heard me talk about this for years if you've been listening to the show. It's now 25 years old. Thank you very much. But if you've been listening to the show for a long time, there are two tax codes in the United States. And it's not one for the rich and one for the poor. It's one for the informed and one for the uninformed. And I would even add a third criteria to that. You know, to know and not to do, you might as well have not known, right? Here is an easy way, a simplified way for you in certain circumstances to be able to get around having to make quarterly payments. Now, my friend Ryan McEwen is with the Wealth Enhancement Group in Minnesota. He's also with me on the Ed Slott Group. Good friend of mine. He's a CPA as well as a certified financial planner. And he wrote about this in an article that just came out very, very recently. He calls this the triple threats of tax planning when it comes to quarterly payments. And it's actually when it comes to any taxation. It's the threat number one is tax overpayment. You gave the IRS too much money. And at the end of the year, you either apply it to the next tax pay period or they refund it to you where you get an interest-free repayment of your own money. Secondly is an underpayment. Oops, you should have given them more. I hate paying the IRS interest. I hate penalties even more. And the penalties and calculations can be a challenge. So those are the three, making sure you get the penalties and the calculations right. Having an underpayment or having an overpayment are the other two. Let's eliminate the triple threat. Well, how do we do that? Well, the answer is if you have an IRA and you're over 59 and a half, so you've separated from the workforce, you can have money taken out of your IRA without any 10% federal penalty, right? If you're inside of a 401k, you can make distributions the same way. I think it's easier, frankly, to coordinate from our end using an IRA. But it's one of those secrets to understanding the tax code, right? When you make a quarterly payment, when I sit down at my desk and fill out that bloody check every quarter, because I'm not 59 and a half, I have to do it this way. When I fill out that check and I remit it to the IRS or submit it, whichever one you want to talk about, it's painful. I have to deal with the triple threat. Is it enough? Is it too little? You know, am I dealing with the penalties being correct in the amount? But if I were over 59 and a half and separated from the workforce especially, where I had to make quarterly payments, and you know, I worked for a company instead of being self-employed, here's one of the things I can do. I can merely instruct my IRA to make a distribution and have 100% of it remitted to the IRS. So let's say over the course of the year, my CPA said, Joe, you need to make 4 quarterly tax payments of $10,000 a quarter, right? So $40,000 in total. I missed the first one. I missed the second one. I'm on the golf course with my CPA, and he says, Joe, you're going to have to pay penalties, and you're going to have to pay interest. Because you didn't make the quarterly payments that I told you to make. And I go, not so fast. I'm going to have the full $40,000 taken from my 401k or my IRA and distributed directly to the IRS. The IRS is going to receive it, but strangely enough, under the rules, it's not based on deemed to have received it on one date. It's done pro rata over the course of the year. As a result, all of my money was in on time. There is no penalty. There is no interest. Voila. It was simple. It was easy to do, right? So let me walk you through the steps again. You've got an IRA. You've got quarterly payments that are due. You merely make a distribution at the end of the year to take care of all of those quarterly payments at one time. If you're at required minimum distribution age, that's a pretty simple decision to do. Your RMD is what goes to the IRS. It may be enough, it may not be enough. Add to it if you need to, pay them less to satisfy the requirement for what would have been your quarterly payments. Except now you're only having to fool with the IRS one time a year. Secondly, what if you didn't want to take an IRA distribution? Because again, that would be more taxable money. Pretty simple. You've got 60 days to be able to replace that money with money from a taxable account. So you may have a trust account. You may have a joint account. You may have an account in your own name. You just sent the IRS $40,000. You've got 60 days to replace that money out of an IRA, not a 401k. You've got 60 days to replace it in an IRA. Merely take $40,000 out of your trust account or your retail account, put it inside of your IRA account. Voila! There's no taxable stuff. Now remember, you can only do that once every 12 months. That's not calendar year. That's once every 12 months. So pay attention to the clock in terms of when you do that. There are also some Roth conversion strategies we can talk about this. Now, for the self-employed person, this becomes critical. And Ryan gave a great example, so I'm not even going to make up one or come up with one of our own. He had a high-end pet company that sold, the toys and the things like that, pet food, that did really, 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 really well, that had to make quarterly payments of $200,000 a quarter to the IRS. That's a big ticket. So $800,000 going out to the IRS over the course of a year. Think about the triple threat, right? Is it too much? Is it not enough? And what will the penalties and interest be? Well, in this case, a major retailer, a big box store, moved in right next to them. And they were afraid that their sales may go down at the end of the year. And as a result, if they made their quarterly payments on time, they would have avoided the penalty and interest, but they also may have been and threatened by a massive overpayment. If their profitability wasn't there, they've given up cash flow they may need to keep the business going. By using the IRA strategy, essentially, what they were able to do was to give themselves more flexibility in terms of how to structure or how to look at this. So they made no quarterly payments. They got to the end of the year. Voila, sales didn't go down. Profitability actually went up. They went into the IRA and they were able to make a single distribution, able to go in to satisfy the IRS so that it looked like the quarterly payments were made across the board. This is not cheating. This is not, doing anything against the tax code. This is using the system as it is written, ladies and gentlemen. I don't want you to think that we're doing anything at all that is wrong with the tax code. We're merely understanding it. Remember, there's two tax codes, one for the informed, one for the uninformed. Right? This is a process of simplifying your life. It's one of the things we do at the Financial Enhancement Group. So in this case, the company had the profitability of $1 million. They were able to put it back in the IRA. Remember, you've got the 60 days. It wasn't taxable. Everything was good. You don't have to be 59 and a half if you think you can replace, by the way, if you're still making a quarterly payment and you're under 59 and a half, you've made the distribution, if you will. Just pay attention to that with your CPA. Money that is leaving is subject to that penalty, but you have the 60 days to be able to put the money back into the account. So the key with tax planning is to make sure that just because you know doesn't do you any good. You actually have to do. Secondly, it requires a lot of thinking and planning ahead of time. You don't want to get caught into what do I do now? Now, truthfully, we get a lot of questions starting in October. That's when we do our tax package that goes out to all of the families we take care of. Happy to get you one if you would like to. You can merely go to yourlifeafterwork.com or call us at 800-928-4001 and say, hey, I want to be on the tax package distribution list. We will send it out to you. We go through about 10 questions for people every year, from income variability to marital changes, whether that be death, divorce, marriage, children. What's changed inside of your tax scenario and what do you need to really think about it? One of the things we're going to highlight in this next week is what's happened with inflation and taxation and how do those two things go hand in hand. We've got to be thinking about our tax planning before the end of the year. How do we simplify? How do we simplify? How do we simplify? That way you have a better chance of acting. Remember the triple threat. We don't want to overpay the IRS. We don't want to underpay the IRS. We don't want to get caught calculating penalties and interest and making sure that computation is right. Let's remove the headache. Let's simplify this. Go to yourlifeafterwork.com or call 800-928-4001. Go to yourlifeafterwork.com. Let's get started on your next steps meeting. Hi, I'm Joe Clark, Managing Partner of the Financial Enhancement Group, and thanks for listening to Your Retirement Playbook. You have a lot of decisions to make. You have a lot of opportunities to be able to decide what to do with the money that you've saved. You've done the heavy lifting. You've worked hard. You've said no to things so that you can accumulate what you have. Now it's time to carry the ball across the finish line, to enjoy your financial journey, to separate from the workforce. Are you tired of volatility and decision making and taxation and not understanding the tax code? Don't you think it's time for you to have a professional fiduciary? If so, give us a call at 800-928-4001 or go to yourlifeafterwork.com. Find out what the Financial Enhancement Group can do for you. Again, if you want to do this on your own, that's your business. But if you're looking for a fiduciary, that's our business. Go to yourlifeafterwork.com or call us at 800-928-4001. Hi, I'm Joe Clark. Welcome to Your Retirement Playbook. Happy to have you along this morning, this afternoon, whenever you're listening. That's the beautiful thing about podcasts, right? You can listen to the show anytime you darn well please. And please do subscribe to our podcast, even if you listen to it on the radio, iTunes, wherever you listen to podcasts, Spotify, but as well as our YouTube channel. Most of the time, I am merely talking. Every now and then I use the whiteboard. But if you want to see the video, the character behind the camera, if you will, you can always go to YouTube. Your Retirement Playbook is the full show. We also have 6 individual shows that focus on just specific topics. Tax planning show, Your Life After Work, the legacy planning show, the investment playbook, the Better Giver show, the life planning show. People ask me about investments all the time. Do not forget to go to our website at yourlifeafterwork.com to get signed up for the Market Carver. That's our weeklet video that comes from Adam Harder, our CFA, our Chief Investment Officer, as well as Andrew Thrasher, our Charter Market Technician, myself or Zach or somebody else chime in occasionally when somebody is on vacation. We are talking in this show today about some of the challenges that really arise inside of the financial world that can get to be frustrating. They get to be complex. And, you know, when I quit teaching at Purdue, I spend most of my time and energy teaching people that we hire and bring into the financial planning unit. And by the way, shameless plug for those of you listening to the radio, we are looking for associate advisors and people that are senior advisors that are listening to the show that would like to interview with the Financial Enhancement Group. It is certainly not right for everybody. But if there's somebody in your family that's interested in this industry, that would like to sit down and have that conversation, we are more than happy to engage in conversation. You can merely go to 800-928-4001 or go to our website and simply type that in as a question, and I will have the right person get in touch with you or somebody on my team will. Understanding what people's roles and responsibilities are critical. I use the word associate advisor and senior advisor. Well, those are great titles, but what do they mean? And inside of the Financial Enhancement Group, they mean a lot. Each of us understands what our role is inside of our box. Some of you are going to be familiar with EOS, the Entrepreneurial Operating System. That's how we function. It's a system of management. Associate advisor, that person understands their roles and responsibilities. Paraplanner, that person understands it. Senior advisor, that person understands it. May not mean anything to you. Right? So let's take this to your life. Let's go to legacy planning. Because at the end of the day, we're going to be gone. It'd be maybe for some of us, I don't want to be that person, but for some of us, I'm told you want to spend the last dollar with the last breath. Right? We just don't know when that last breath's coming, which makes that very, very difficult even for you to do. That's not my intention, not my design. I want to leave behind something for the next generation and for the charities and places that I care about. Taking care of my family. But when you look at this, you're going to hear various titles that people throw around: power of attorney, durable power of attorney, healthcare directive, executor, trustee, successor trustee. And what I've found in 35 years of being in this industry, that it is a lot like associate advisor and senior advisor. You hear the names and you may have a little bit different understanding, but you don't have a definition exactly what to expect of each of those roles and responsibilities. So what exactly is the difference between an executor and a successor trustee? Now, I've got to tell you, I'm not an attorney. I don't play one on TV, nor radio, nor YouTube. I have attorneys that I work with, collaborate with all day long. So if I miss this from a legal standpoint, please forgive me. But my executor takes care of all of the things that are not owned by my trust. My trust is managed by the people that are my successor trustees. Now, in many cases, the person named the executor in your will is also the person named as the successor trustees inside of your trust. So they may have overlapping or over defined responsibilities. In my case, they're not the same. And you need to know that. You need to be aware of that. Because for some people, that's right. And for some people, that's wrong. I'm a fan of trust. I have yet to have somebody explain to me in the world that we live in today why a will is sufficient if I want to have some of the following. One, privacy. I don't think the world needs to know everything that Joe Clark owned. I'm not ashamed of anything. There's nothing hidden in the closet. But, where I leave my money, how I leave it to other people, I believe is my doing, not other people. If it is held in a will, that's public knowledge who receives money. If it's held in a trust, it's private. Secondly, I want to be able to have some control over how my assets are distributed at the end of my life. And some people say, well, Joe, my will does that. And in most cases, it does that via what's called a springing trust. A trust sprung to life after you were gone. Why in the world would I want a springing trust if I could just have a trust? Why not just do it so that you can control it and understand it prior? And again, I'm not an attorney, not practicing law. I work with attorneys. Your estate planning attorney or my estate planning attorney, that's fine. We have a multitude of them we work with. But, so I'm not trying to practice law here. I'm just telling you my opinion of this. I want as much control over that as I can. So privacy, control, simplicity, I want it to be very, very simple. But at the end of the day, there's some other reasons too, but at the end of the day, the biggest one obviously is avoiding probate, so I want to get that out. In my will, that has to go through the probate process. Inside of my trust, it does not. So I'm a fan of of utilizing a trust. Somebody has to be in charge of that trust when I can't do it in the event of one of two things. I die. Now, we will all die, so this is 100% available. Or 100% actionable. I will die. It will happen to all of us. And so I think people put more emphasis on the death part of what happens to their assets when they're gone, which is why it's very easy to say, hey, Joe, I really don't care. I'm not here. A will is just fine. If I'm not here, they can sort it out. They can separate it. It's all good and done. The challenge is, remember I said there's two things that can happen when I'm incapable of taking care of it myself. One is I die, and I will die. The second, though, is when I become mentally or physically incapacitated. I don't like this, but statistically, that is probable. Yes, the American Medical Association now tells us 52% of us will pass with a diagnosis of dementia. I am not comfortable spending 40-some years of my life accumulating assets, saying no to Disney, no to things that I could have done in order to save and accumulate money for a future generation. I am not in any way, shape, or form comfortable thinking that I will allow myself to make financial decisions while simultaneously being diagnosed with dementia. And what I commonly hear from people is, Joe, my kids would never let that happen. All I'm telling you is in 35 years I've done this, I've never seen kids stop somebody from doing it. Right? Now, that's not fair. Never's a long time. If you're put in an institution, I've watched your kids do it. If you've lost, I've watched them take your keys to the car and say, Mom, Dad, you can't drive. I've watched people in their late 80s, specifically in their 90s, say it's probably time for me to intercede and take over the checkbook. And the parents generally do that willingly. I've also watched them vehemently object. There's a family in Anderson that I talked to. He's 88 years old. He's accumulated a bunch of money. His 60-plus-year-old daughter is saying, Dad, you need to give Joe the money. The wife is saying, please, honey. And the dad obviously has no ability to make financial decisions, but they won't follow the documents that are put together because they don't provide for a transfer of that control. And I have no idea what's happening to the money or the resources. We don't manage it. We just understand the problem. So in that successor trustee, you've got to name somebody who's going to step in the event you die. That's one. Or two, in the event that you're mentally or physically incapacitated. Now, here's the tree of decision-making that most people endure. The first one is that they look at it and they say, okay, I don't really have anybody in my family to be able to make these financial decisions. So I'm going to leave this to a professional to be able to take care of it. And so they'll name a bank because most financial institutions are not don't have a trust services division. The Financial Enhancement Group does. You can name us as the successor trustee inside of your trust. Now wait, there's more. Don't just go out and call your attorney and do that by itself. The second decision in the tree is many people say, well, from a character trust standpoint, I trust my kids or my spouse more than anybody else on the planet. I know they won't hurt me. I know they won't make any bad decisions intentionally. And I trust them, and I don't know this person working at the bank, or I don't know this person at the Financial Enhancement Group. Fair enough, right? And so they'll name their kids as successor trustees. The problem, in my opinion, is the financial trustee has no business taking care of your life issues, right? Yet they've been named successor trustee. In most trusts, they're given the obligation, the responsibility to take care of not just financial obligations, but actually generally caring for you in terms of the income needs and the things of that nature. Your kids, on the other hand, if you name them, may have no understanding of what to do with the assets and the resources that you created. So inside of my trust, I have two sets of successor trustees. They are indeed in charge. I have a mechanism in place when I am mentally incapable of making my decisions, and that's a whole nother conversation. But when I'm mentally or physically incapacitated or dead, there are two sets of successor trustees that kick in. The ones that take care of my life issues, where I need to live, the doctors that I go to, how much money I need monthly to be able to maintain the standard of living, what I need to have happen at my home. And then the second side is the professional management of the assets, that I've saved and accumulated in IRAs and 401ks and the value in the trust account or the brokerage account that we build over time. The successor trustees' roles can be split, but you need to be able to think about those two things that can happen, not just one. You will die, that's guaranteed. Less of us will become mentally incapacitated, that is true. But if that incapacitation comes to you, it can disrupt, it can destroy 40 years of hard work and labor of accumulating assets. It can wipe out family generational wealth. Don't let that happen to you. Go to yourlifeafterwork.com. Ever wonder what goes on in the mind of a money manager in a crazy period of time like this? I bet you do. And every week, we're willing to tell you. We manage more than $600 million for families in more than 30 states, 1,100 families and change. And every week, we have an allocation team meeting where the people responsible for the management of those families and that money come together and communicate over what we believe is most important in the economy and the market the week before. We break that down into a brief that we call the market carver, where we break the market into pieces. And we're more than willing to share it with you. Every Thursday morning, we'll email it to your inbox. Just go to yourlifeafterwork.com and get signed up for the Market Carver. You'll get that email, you'll get our thoughts, our understanding, and when you're ready, we're more than happy to sit down with you and have a next steps meeting. Again, it's yourlifeafterwork.com. Just request the Market Carver. Good morning and welcome to Your Retirement Playbook. I am your host, Joe Clark. Happy to have you along. Hey, there are 3 phases of finance that you have gone through, will go through, or need to prepare to go for. I know we have a 16-year-old who listens to this show every week, and when it is time for you to become a financial planner, I fully intend on you coming to the Financial Enhancement Group, being one of our interns. Hopefully we'll have that program fully vetted by then and ready to roll. In the meantime, if you're an adult looking to be in the financial services world, we are more than happy to sit down. We are hiring associate advisors and senior advisors in multiple areas within the Financial Enhancement Group. Happy to have that conversation. The Financial Enhancement Group is a team of 37 people. And when I say a team, I mean it's a team. We all have our sweet spots. And it really, really bothered me when I was growing up. I think at McKinley Middle School in Muncie, where I was born and raised until I was 16. Seems like we had 7 grades on our report card. It may have only been 6. All I know is they were all A's and a C-. And the C- was in drafting. I couldn't draw a straight line to save my soul. With a ruler, T-square, and all that stuff that we had. Handwriting was the same way in elementary school. It's not one of those gifts that God gave me. And parents, we would sit down every time, and they would go, "Hey, these A's are great, but what's this C- thing about? Do you realize that's almost a D?" And we would work on that. And my philosophy at the Financial Enhancement Group for years has been as a team, and we are a team, I can focus on my A's and turn them into A+. I can focus on my ability to learn and my ability to teach and my ability to communicate and stay away from my inability to deal with the minutia and the details that drive me nuts. And I can hire people on my team, the other 36 people, that are able to be very, very good and complementary with the details so that we can come together and focus on individual A's and create a great report card working collectively. Now, why do I bring this up? Well, it's because I have 37 people on my team. See, we know as a matter of fact that success is never dependent upon one thing, but failure can be. We know, and that's from James Clear, we know, by the way, that successful retirements is based on knowing where it is you want to go, your financial vision, and then it's based on how do you separate from the workforce, or what we call your life after work, the annual tax plan, the investment playbook, the life happens, the things that just come out of nowhere, good, bad, and ugly, and last but not least, the legacy plan. We know it's a collective of all of them. And as an individual, if you've got a C- in one of those like I had in drafting, you can blow the whole deal. And you can say, well, you know what? I can go out and I can hire just somebody to do that part. But the problem is, if they're not set in a world of collaboration, many times I've seen what attorneys do in documents does not coincide with your investment philosophy. Or I've seen people hire investment people and say, no, I'm going to keep the CPA and the investment people separate. Or they know each other at Rotary, but they don't truly collaborate. They're friends, but they don't work together. Ladies and gentlemen, you really need a coordinated, collaborative effort in order to get this done. Use your A's, yes. Use your understanding, yes. But go out and hire a team that's able to get all of this stuff done for you. Now, I'm going to take you to the Roth conversions because we ran across an interesting case this past week where somebody was talking about this period of the market, and they were down in the glooms and just really in the ruts. So there's just nothing good going on right now. I don't like the political climate. I don't like what Putin's doing. I don't like what I hear about gas prices, even though they're going back down now. I don't understand them. I don't like about this inflation bill. They really didn't have a lot to like. And, I sit down with them. I said, well, have you thought about this, this, and this? And the answer was no. Right? So you get to choose what to focus on every day, right? You get a look at what I call those 5 critical elements, part of our family-focused process that we trademarked. It's proprietary. You can look at those 5 areas, and you can find doom and gloom, or you can go, okay, what is my best opportunity right now? What is it that I want to do? It's kind of like a golf shot when I'm stuck under the tree, right? I can't take a full swing. I can't do it the way I would like to do it. It doesn't mean that I'm just going to stare at the golf ball all day. It's not going to move itself, and the round's going to come to an end. your financial journey, ladies and gentlemen, does not come to an end, right? So let's look at where we are in the world. So you've got money that's not in an IRA. Let's start there. It's not in an IRA. It's gone down in value, right? Because the market's gone down in value. Yeah, I know it. Everybody, some have done better than others, but for most people, the market is down in value. Great. Now is a time for you to be able to reprioritize the purpose of that portfolio. What is the strategy? Has anything changed in your mindset? Because now is an ideal time to sell and capture losses, even if you're going to re-engage and reinvest in another asset of very similar quality or circumstance, right? That's one of the beautiful things in the IRS. You can take a capital loss. You can invest in the same asset for 30 days, but there's so many things that look, act, and smell like that same asset, you can still do it. You say, well, Joe, I can only use $3,000 of a capital loss this year. That's true, but you can bank them on into the future. You don't have a clock like you do on charitable gifting where it runs out at a certain period of time. This you're able to use over an extended number of years and be able to apply to capital gains in the future. Remember, it's about your financial journey. It's not just about today. But let's move to the Roth conversion. This is one of my favorite things. In the Roth, remember, you have two C words, conversion and contribution. A contribution is indeed limited in terms of the amount that you can contribute based on your age, right? If you're over 50 or over, you can put in more money than if you're 50 and under. It's based on income. You have to have earned income to be able to contribute. And if you make too much money, you can't contribute directly into a Roth IRA. So it's based on age, and it's based on age for contribution, and it's based on income in terms of being able to do the contribution. And it is limited. If you're over 50, you can put in $7,000 a year. Right? So nothing compared to a 401k contribution, for instance. However, if you're any age, at any income, you can still do a Roth conversion. And somebody said, well, Joe, why would a 90-year-old do a Roth conversion? Well, it's real simple. They believe that the market is down. My oldest, by the way, is 92 for Roth conversion. They believe the market is down, and they don't think they're going to spend the money, and they believe that their beneficiaries will inherit the money, and it would be better for them to inherit money tax-free than it would be after tax. And in this particular case, they have an IRS estate tax potential liability, especially if the code reverts back in 2025, effective 2026, based on what we know to be true today. In this case, their IRA was down a few $100,000 relative to where it was. They believe that's temporary, not permanent. They believe and trust in the asset management, the fiduciaries they work with. And so they were able to make the decision to do a Roth conversion right now. Their age didn't matter. They're converting $300,000 less than what they would have in the beginning of the year, right? So at their tax rate, that saved them about $100,000 in income tax. They converted the same amount of percentage of their IRA. They did a conversion of the same percentage of their IRA, but the tax ramification today was about $100,000 less because the market is down. Now, they believe, no guarantees, I can't guarantee that, they believe that the market is going to work its way back up, that their beneficiaries will receive that all tax-free now and not have to pay the $100,000 worth of tax liability when they go to pull the money out. Additionally, the $100,000 that they paid in income tax today reduced their gross estate by $100,000 because they paid it to the IRS while they were alive. All sorts of good things to think about here. So if you think that in the future, the assets that you have will go back up a year, 2 years, 5 years from now, and you have the resources to pay the taxes, considering a Roth conversion is an ideal thing to be thinking about right now. Just some notes that we've got here that came from the slot group. Recharacterization is no longer available. Keep that in mind. So one of those things that we used to help people do is do Roth recharacterizations, and then conversions and then recharacterize. You can't do that anymore. There's no way to undo it. A Roth IRA conversion makes sense for those who are concerned about future tax rate increases. January 1st of 2026. They've already told us. It sunsets back to 2017. Our tax rates go higher January 1st of 2026 unless the Senate agrees to change that between now and then. Roth IRAs are not subject to required minimum distributions during the IRA's owner's lifetime. So you eliminate future RMDs, and one reason why you may want to consider the conversion. Smaller, partial annual Roth conversions over several years can lessen the tax impact. Please don't take what I just said and go do it all in 1 year. That would be a mistake. We lead people through a financial journey, but do take advantage of variability. Variability of age. As you reach certain ages, there's things you should consider. Some you're forced to, some are opportunities. There are variability of the market. Sometimes the market's up, sometimes it's down. Be wise in the decisions you make. There's income variability, deduction variability. You may have a lot of healthcare costs this year. Last year you didn't, next year you wouldn't. A lot of issues that change on a tax return every year. Think about variability as you make decisions. Older individuals may think they don't have a long time to reap the benefits of a Roth conversion, but that overlooks the potential of a conversion as an estate planning strategy or a gift for their children, grandchildren, and other beneficiaries. Yes, you can make grandchildren beneficiaries of Roth IRAs. Be careful doing that in terms of IRAs because of kiddie tax and other issues that are there. But Roth IRAs, they be a beautiful, beautiful deal in terms of decisions that you can make and things that you can go along the way. You should be aware Roth conversions do increase your income. So stay away from the Medicare issues. You don't want to get your premium tax up. That would be one. But two, look at that variability. Make lemonade when the lemons are out, the market's down. Take advantage of this right now. Most common question I get after doing Your Retirement Playbook is, Joe, how can you talk for an hour and not talk about a market that is decimating and destroying people's future? And my answer is real simple. One, we talk about the market every week on the Market Carver. Something that you can get. We'll email it right to your inbox. It's Adam Harder, our CFA, Chief Investment Officer, one of my partners, Andrew Thrasher, a chartered market technician. That's all they do all week long is deal with the market. But here's what I know about the market. For most of us, it is a lagging indicator. Here's what the market did. Our statements come, oh my, and then people try to make decisions over a lagging indicator, something that's already occurred. What I care about is leading indicators, things that I can do today that make your financial lives better. We devote this hour every week to Your Retirement Playbook to give you ideas, to give you insights on things you need to consider. Now, ideally, we hope that you pick up the phone and call 800-928-4001 or go to yourlifeafterwork.com. If you want to do this on your own, that's your business. But if you're looking for a fiduciary, that is our business. You can go to yourlifeafterwork.com, get signed up for a Next Steps meeting. It's 90 minutes long. It's complimentary. We'll take your information, your situation, the work that you put into this. We'll give you things that you want to consider today, things you're going to want to consider in the future. And if we choose to partner together, what FEG will take off your plate, what we'll do for you, and we'll put it into writing. We'll give you a 180-day written commitment about what to expect in our relationship. 180 days that I believe can change your financial journey, can change your future. 800-928-4001, yourlifeafterwork.com.